Hey, how's it going, everyone? So in today's video, I thought I'd put together 3 ways that you can save money and actually pay off your mortgage a lot quicker. Now, if you stay to the end of the video, I'll also add another tip that could save you even more money. So if you're looking to buy, thinking about buying maybe sometime in the future, this video is great for you so you don't make any mistakes, and when the time comes, you'll be fully prepared. Now look, there's 2 numbers that we have to focus on. That's principal and interest. The principal is the actual loan amount that you take out. So for example, if you purchase a $500,000 property and you have a loan of $400,000, that's your principal amount. Interest is what you're paying on top of that on a monthly basis because you're borrowing that amount from a lender. So with that being said, I'm going to show you 3 different ways on how we can actually save you some money here and get you to pay off your house and your property quicker. So the first thing is actually enroll in a bi-weekly payment plan. What that means is instead of you paying your mortgage every single month, you pay half of your mortgage bi-weekly. So instead of the monthly payment, let's say for example, it's $2,000 a month, you pay $1,000, but you pay it bi-weekly. So you pay it every 2 weeks. Now the reason this actually benefits you and helps you is because there's 52 weeks in a year. Now if we divide that by 2, that's 26 payments. And if we divide 26 payments by 2, that's 13 months. So you're paying 13 months worth of payments in a full year instead of 12 months you would have been paying if you were paying on a monthly basis. So that extra payment can go entirely to your principal amount, which will save you years of extra payments so you can pay your property off quicker. Now, not only would you be paying it off quicker, but you'll be saving years of additional interest payments. So that will save you tens of thousands of dollars in interest payments, depending on the price point and the property that you're going to be purchasing. Now, number 2, refinancing. A good rule of thumb is if interest rates are about 0.75 or 1% lower than your current interest rate, it may be a good opportunity to reach out to your lender and see what type of options there are for refinancing. Refinancing that 1%, for example, will actually save you a good amount of money in the long term. Now, before you do this, we want to make one quick calculation. So take out a piece of paper, get a pen, and first figure out if this is what's right for you. Refinancing is not free. So let's do a quick calculation, and that's why it's good to speak to your lender to see how much more or less it would cost to refinance. Let's say hypothetically speaking, it's about $5,000 to refinance. Now, if doing the refinance will save you $200 a month in your mortgage payment, how long will it take for you to break even and recoup the money you spent to refinance? Well, how do we do the math? I'll tell you right now. Take the amount you're going to be paying for the refinance, in this case $5,000, divide that by the amount you'll be saving in your mortgage payment every month. Let's say it's $200. After doing the math, you'll see 25 months. It'll take you 25 months to recoup the money that you're going to spend on refinancing. Now, if you're planning on staying in your property for only a year, then financially, this wouldn't be the best option. Now, if this is your forever home, it might be a great option for you. And this could save you a lot more money down the road. So it's definitely to take into consideration refinancing, but only in certain scenarios. Now, the third way to actually save money, which can be thousands of dollars extra in your pocket, is, and this only pertains to people who have less than 20% equity in their property. Anyone who has 15, 10, 5% equity in their property or goes in with a down payment of 5%, 10, 15%, has something called PMI. Now, what is this? It's mortgage insurance. Now, PMI could be a few $100s a month, but as soon as you get 20% equity in your property, you can actually get rid of PMI. Now, why this is beneficial for you is because as soon as you hit 20%, instead of you paying that additional amount of money every single month, you'll be able to save that and put that in your pocket. And by law, lenders have to terminate PMI if your property gets to 22% of the value. It might not seem like that much more, 20% equity compared to 22% equity. But you have to remember, getting from 20% to 22% are lots of payments. That will be thousands of dollars that you could put in your pocket that you'll be paying for PMI when you don't even need it. So remember, to keep track of how much equity you have in your property and make sure that when you're getting close or at 20% equity, you call your lender so you can get rid of PMI for good. Now look, this is the extra tip, and I think it's a super beneficial one that a lot of people don't even realize is there. So you should definitely reach out to your accountant, your CPA, and speak with them, because there is a high probability that you can actually write off and take a tax deduction for the amount of money that you pay every year towards interest for your loan. So again, I'm not an accountant, I'm not a CPA, but if you have one, I think it'd be beneficial to at least reach out to them. Now, if you have any questions, make sure to comment down below. And I would really appreciate if you subscribe to the video. I'll continuously release more information to clarify the home buying process, as well as just real estate tips that could put you in a better position financially. Again, subscribe to the channel, and I'll see you in the next video.